Imagine you're a captain steering a ship through a violent storm. The waves are crashing, the wind is howling, and the sky is dark with uncertainty. Every instinct might tell you to panic, to abandon ship, to turn back. But what if I told you that the storm you're facing, this turbulence, is the very opportunity that could define your journey? What if I told you that learning to navigate through the storm, rather than avoiding it, is the key to reaching your destination? Just like the captain of that ship, you have the power to steer your financial future through the market's volatility. The storm is here. The question is, are you ready to navigate it? In the world of investing, market turbulence is not just an occasional hiccup, it's a reality that every investor must face. The stock market, the global economy, and even personal finances are all subject to fluctuations. Economic downturns, political upheaval, pandemics, natural disasters, these are just a few of the forces that can send shockwaves through the financial markets, leaving investors feeling uncertain, fearful, and sometimes paralyzed by indecision. But here's the truth: market turbulence is inevitable. It's not a matter of if it will happen, but when. The key to financial success is not about avoiding these periods of volatility, it's about learning how to navigate through them. It's about maintaining a clear vision of your financial goals, understanding the dynamics of the market, and making strategic decisions that will protect and grow your investments even when the seas are rough. We'll discuss the importance of staying calm, the power of a long-term perspective, and the value of diversification. We'll also explore the psychological barriers that can cloud your judgment and how to overcome them. Most importantly, we'll emphasize the need for determination, discipline, and an unwavering belief in your financial plan. Market turbulence is like a storm at sea, unpredictable, sometimes intense, but a natural part of the journey. To navigate it effectively, you first need to understand that volatility is not an anomaly but an inherent characteristic of financial markets. The stock market, in particular, experiences cycles of growth and contraction, often influenced by a complex interplay of economic indicators, investor sentiment, and external events. Market volatility refers to the rapid and unpredictable changes in the price of assets within the market. These fluctuations can be triggered by a variety of factors, including changes in interest rates, inflation, geopolitical events, technological advancements, and shifts in consumer behavior. While these changes can be unsettling, they also present opportunities for investors who are prepared. It's essential to recognize that volatility is not inherently negative. In fact, it's the very thing that creates opportunities for profit. Without volatility, markets would be static, and the potential for growth would be severely limited. The key is to understand that these fluctuations are temporary and to resist the urge to make impulsive decisions based on short-term movements. One of the biggest mistakes investors make during periods of market turbulence is losing sight of the bigger picture. It's easy to get caught up in the daily ups and downs, but successful investors understand that the market is a long-term game. Historical data shows that despite periods of volatility, the overall trajectory of the market has been upward over time. For example, consider the performance of the stock market during major economic crises such as the Great Depression, the 2008 financial crisis, or the COVID-19 pandemic. In each of these instances, the market experienced significant downturns, but eventually rebounded and continued to grow. Investors who stayed the course, rather than panicking and selling off their assets, were able to recover their losses and benefit from the market's recovery. When the market is volatile, it's easy to get swept up in the emotions of fear and anxiety. The media often exacerbates this by sensationalizing market movements, leading investors to believe that every dip is the beginning of the end. But here's the reality: short-term volatility is just noise. To achieve financial success, you need to drown out that noise and focus on the long-term horizon. A long-term perspective allows you to see market turbulence for what it truly is: a temporary disruption in an otherwise upward journey. When you have a clear long-term financial plan, you're less likely to be influenced by short-term market movements. Instead of reacting impulsively to every dip and rise, you can make informed decisions based on your overall strategy. Consider this: if you're saving for retirement, which is likely decades away, why should a market downturn today cause you to abandon your plan? Your investments have years, if not decades, to recover and grow. By keeping your focus on the long term, you can avoid the emotional roller coaster that comes with trying to time the market or chase short-term gains. Patience and discipline are your greatest allies when navigating market turbulence. It takes discipline to stick to your investment plan, especially when everyone around you is panicking. It takes patience to wait out the storm, trusting that the market will recover in time. One of the best strategies for maintaining discipline is to automate your investments. by setting up automatic contributions to your retirement accounts or investment portfolio, you remove the temptation to time the market. This approach, known as dollar cost averaging, allows you to consistently invest in the market regardless of its current state, reducing the impact of volatility on your portfolio. Warren Buffett, one of the most successful investors of all time, is a firm advocate of long-term investing. His strategy is simple: buy quality stocks at a fair price and hold them for the long term. Buffett has famously said, "Our favorite holding period is forever." This mindset has allowed him to navigate countless periods of market turbulence without losing sight of his long-term goals. Buffett's success is a testament to the power of patience and discipline. He doesn't try to predict short-term market movements or react to daily news headlines. Instead, he focuses on the intrinsic value of the companies he invests in and trusts that, over time, that value will be reflected in the stock price. Diversification is a fundamental principle of investing, especially during times of market turbulence. By spreading your investments across a variety of assets, you reduce the risk that any single investment will significantly impact your portfolio's overall performance. In essence, diversification is about not putting all your eggs in one basket. Diversification involves investing in a mix of asset classes, such as stocks, bonds, real estate, and commodities. Each of these asset classes reacts differently to market conditions, so when one is underperforming, another might be thriving. This balance helps smooth out your portfolio's returns over time, reducing the impact of volatility. Within each asset class, it's also important to diversify further. For example, if you're investing in stocks, don't just invest in a single company or sector. Instead, spread your investments across different industries, geographies, and market capitalizations. This way, you're not overly exposed to the risks associated with any one area. Asset allocation is the process of determining how much of your portfolio should be invested in each asset class. Your asset allocation should be based on your risk tolerance, financial goals, and time horizon. During periods of market turbulence, a well-thought-out asset allocation can help you stay on course and avoid making rash decisions. For instance, if you have a low tolerance for risk, you might allocate a larger portion of your portfolio to bonds, which tend to be less volatile than stocks. On the other hand, if you're younger and have a longer time horizon, you might allocate more to stocks, which offer higher growth potential but come with greater volatility. Over time, market movements can cause your asset allocation to shift. For example, if stocks perform well, they may end up taking up a larger portion of your portfolio than you initially intended. This can increase your risk exposure. Rebalancing involves periodically adjusting your portfolio to bring it back in line with your target asset allocation. Rebalancing is particularly important during periods of market turbulence, as it forces you to sell high-performing assets and buy underperforming ones, effectively following the buy low, sell high principle. While it may seem counterintuitive to sell assets that are doing well and buy those that are struggling, this disciplined approach can help protect your portfolio from becoming too risky. Navigating market turbulence isn't just about understanding the markets, it's also about mastering your emotions. Fear, greed, and anxiety can all cloud your judgment and lead to poor investment decisions. To be a successful investor, you need to recognize and overcome these psychological barriers. Fear is one of the most powerful emotions that can influence your investment decisions. During periods of market turbulence, it's natural to feel afraid of losing money. This fear can lead to panic selling, where investors sell off their assets at a loss in an attempt to avoid further declines. However, panic selling often leads to locking in losses and missing out on the subsequent market recovery. Remember, market downturns are temporary, and history has shown that markets tend to recover over time. Instead of letting fear dictate your actions, focus on your long-term goals and trust in your investment strategy. On the flip side of fear is greed, the temptation to chase returns by investing in high-risk assets or jumping on the latest market trend. During bull markets, it's easy to get caught up in the excitement and take on more risk than you're comfortable with. But greed can be just as dangerous as fear. Chasing returns often leads to buying high and selling low, the opposite of what successful investors aim to do. Instead of succumbing to greed, stay disciplined in your investment approach. Stick to your asset allocation and avoid the temptation to chase short-term gains. Emotional resilience is the ability to stay calm and composed during periods of market turbulence. It's about maintaining a rational mindset and making decisions based on logic rather than emotion. One way to develop emotional resilience is to educate yourself about the markets and your investments. The more you understand, the less likely you are to be swayed by fear or greed. Another strategy is to remind yourself of your long-term goals and the reasons why you're investing in the first place. Write down your financial goals and refer to them when the market is volatile. This can help you stay focused on what truly matters and avoid making impulsive decisions. Remember, successful investing isn't about avoiding risk, it's about managing it. It's about staying disciplined, sticking to your plan, and trusting that the storm will pass. Financial success is not achieved overnight, but through consistent, informed decisions made over time. The market will have its ups and downs, but your financial journey is yours to control. Will you let the storm dictate your course, or will you take the helm and steer toward your goals? The choice is yours. If you found this information helpful, please give this video a big thumbs up. Your support means the world to me and helps me create more content like this. Don't forget to leave a comment below, sharing your thoughts or asking any questions. And if you know someone who would find this useful, hit that share button. Together, we can grow this community and learn together. Thanks for watching, and I'll see you in the next one.